year because that's the global benchmark. Everybody watches that. It also tells you about the long-term interest rates in US, and the whole world is, at least from the interest rate point of view, kind of rest of the world is quite linked. Now, 2 year nobody used to watches. I mean, I think it depends on what is the circumstances. So right now, it is important to watch 2 year because that is going to tell you any inflation, and actually you can also watch the 5 year as well. The any what market is pricing and whatever they know right now, right? I mean, they know that inflation is higher, and inflation probably will remain higher in 2022, but will come down after that. So on an average, I mean, as I said, right, the 5 year inflation expectation 2.7%, which is basically saying that on an average from here till 2000, in next 5 years, inflation will average around 2.7. So they say that right now it is 7. So on inflation, the expectation is that it will start moving lower from Feb or March. That's what in reverses, and then it'll go down, but probably end the year say around 3%, and then keep going down to bring the average to about 2.7 over the next 5 years. So 2 year and 5 year will becoming important because if any changes in that expectation is there, it will start getting reflected in that particular yield curve. So I would say about 2 year and 5 year, 2 year more important than 5 year, but yeah, important. Of course, 10 years is always important. You always look at 10 year, especially for equity market because the risk premium in equity market gets derived out of the 10 year long term curve, which is 10 year. So that is why for the risk premium point of view, look at the long term, but currently you also look at 2 year, 5 year. Sorry, Krishna, the second point. What was your second question? I forgot.
Is it that the long term inflation or the long term the long term Fed rate does can it not exceed the 10-year bond?
See, what is a 10 year bond, right? I mean, it's the bond can be broken down into two things, right? What is how the market is expecting the Fed rate to go up, and of course, in a long term bond is a kind of a term premium as well. So I will not say that the policy rate cannot go above 10 year bond. Policy rate can very much go above the 10 year bond. And there were circumstances even in 2017-18 as well when actually the curve inverted, right? So when the curve, I think there are too much of a technical points I'm bringing in here, but of course, Fed can do whatever they want to do, and Fed assuming takes the policy rate higher, but it is very well possible that actually when the Fed is raising rates higher, the 10 year bond actually the yields may go down. What it will tell you is that that Fed is making a mistake, right? That they shouldn't be hiking rates, but of course they're hiking rate now because they're hiking rate more than required. It will have an impact on the GDP, and because it will have an impact on GDP, again the Fed will have to come and cut the rate, which is what happened in 2019, by the way. That Fed actually tightened more than required, and then they had to cut. And that's why the 10 year rate 10 year rate can be lower than the policy rate. So it's possible, but it'll tell you I'm sure you guys read about the steepness and the flatness of the curve. I mean, and the way to look at is look at the yield difference between 2 year and 10 year. The more the flatter the curve, and when the curve inverts, actually Federal Reserve Bank gets worried a lot, and this is what happened in 2019 because it tells you that Fed is making a mistake.
Fascinating. So now, how does all of this affect the Indian equity markets?
Sure. So as I said, right, I mean, first of all, to big thing to understand is the correlations. So just to repeat what I said, there is literally zero correlation between US rates and Indian rates. I mean, and I've been a rates trader, so though we used to watch on a day-to-day basis, but literally there is no correlation. Second is between US equities and Indian equities, there is a correlation, but the correlation is very weak. It's about 0.35. So that is one thing to understand the impact of the movements in US. And I mean, if you look at 2000, they call it a lost decade, right? After the dot-com bubble burst, in those 10 years, US literally had a zero return in their equity markets. And we all know with the Indian equity markets did very well, right? Because of the period between 2003 to 2008. So there's not much of a correlation. Now, the some of the inflation, of course, and India has always been a very inflation prone country, right? Our inflation, I mean, for a change, our inflation right now is lower than US. The last data which came was 4.9% or so, and in US, that's 6.8. But that's frankly, I have never imagined that I will see this in my life. Right? India has always been a high inflationary country. We've always struggled with controlling inflation, and that's why our policy rates are, of course, always on the much higher side. Right? When I joined this industry, the policy rates used to be 14%. And in front of me, a whole policy rate went down from 14 to about 4% in from 97 to about 2003. So India has always been a high inflationary country. So we're always worried about that. I mean, the other thing about the to understand about the interest rate and why specifically US rates becomes important is that India is a net capital importer. Right. What does it mean? That we are always starved of capital. We always need more money. We always need more inflow to come. And when inflows dries up, it shows up in our foreign exchange rate, and which is what happened in 2013, right? When the tapering tantrum happened, and then we had to issue those NRI bonds and all. So from the macro stability point of view, most of the countries look at specifically emerging markets have to really look at US interest rates and keep the difference between them, which usually typically reflects the inflation rate differential between US and India, but and then that brings in the macro stability. So from RBI point of view, from the monetary policy point of view, they always look at that. Now, where are we right now in India is that, our CPI for a change is lower. It's at 4.9. Frankly, the last expectation was that it'll come above 5. It didn't come. Now, why is CPI lower? The big part of the CPI is food inflation, which constitutes about 25% of CPI, and it's in some two handle, like 2% or something, and that's why the CPI is lower. So expectation is that the CPI will go up. Probably it can even if food uh, kind of even stabilizes here, food prices, which actually in winter season food prices usually go down, but even if it stabilizes here, the calculation shows that inflation actually could be 7 plus or even touching 8 or so. So so inflation is expected to go up from here in India, and we have inflation targeting mechanism at MPC, which basically will definitely get RBI to act. Now, what has RBI been doing so far is that again a little bit of a technicality, but they have kind of been tightening. Frankly, you guys don't realize that outside the fixed income market, but uh, there is an overnight rate at which RBI, if banks have surplus money, they can give it to RBI. That rate has been going up, right? They've taken that rate from say 3.35% to they've taken that rate to around say 4%. So that they've been kind of tightening. Now, what is market pricing in? And we have our own way of looking at the market pricing in terms of the RBI rate move. So market pricing in, and when we get it through the interest rate swaps market, so market is pricing in again 3 rate hikes by Reserve Bank next year. So uh, so from say 4%, the expectation is that the RBI will hike the rate to 4.75 by next year December, and then subsequently it'll go up to even 5.75 as well. But having said that, if you look at the big picture interest rate, right? Interest rates typically in India has been, especially the policy rates, you can say has been between say 5 and 7%, right? We are at actually below the range right now. If you look at 4, right, and even if they hike the rate by another 150 basis points or 200 basis points, it'll still take up in the range. Now, can they have an impact on the equity market? I think my view is that interest rate alone doesn't have a much impact on the equity market. The big impact on the equity market comes through the liquidity. Right? And the liquidity, what I'm talking about is the liquidity in the banking system, right? And why is that? Because the liquidity in the banking system will determine how and how fast and how much loans banks can make. And the economy gets more driven by how much money gets created within the economy, and which is typically through the credit generation, right? So bank typically lends money, which basically the faster the bank lends money, the faster the velocity of the money is, and that is what goes much into the GDP calculations. So for me, I would say, interest rates are expected to go up in India, which is kind of priced in into the market. It's not as visible as probably you can see it in US, because there are inflation bonds which get traded here. I mean, literally you can say there's nothing which gets traded. Uh, but to me, I don't think that should have a big impact on big impact on the equity markets here. The bigger impact actually will come from liquidity right now, which is very easy. The banking system is flushed with about 11 to 12 lakh crores of surplus liquidity, and there is no way RBI can take that out. I mean, they will try and take that out some money, but there is no way that RBI can take all of that money out very soon. So the bank will have liquidity, which basically means that bank should be more keen to lend more money. Of course, when rates RBI will hike rates, bank will also hike their credit. So my big picture view is that the globally market is saying that there is not much of a impact on the higher inflation which you're seeing. People may call it 50-year high or whatever. So eventually it will settle down. Rates will go up everywhere, but rates are at historic low as well, right? So if interest rates goes up by 150, 200 basis points, it should not have that much of an impact. And we have seen much higher rates than this earlier, and it didn't make much of an impact. So that is a big picture. I'll stop here and ask for if any questions you have.
Yeah. So great. That was really insightful. And yes, liquidity is going to be the key factor to watch. And as you said, I mean, three rate hikes would be expected in 2022. I want to get your sense on how that's going to affect one the sensitive sectors such as lending and real estate, and second, what is your view on credit growth in India, and what role will this increasing rate cycle play on credit growth going forward?
So I think that's a great question. So there are a few ways to look at, right? I mean, actually, since the time this whole NPL issue has been there in the banking system, and the last 4 or 5 years, the credit growth has been very, very poor. Right? I mean, it's been single digit and probably lower single digit as well. And if I think what I saw, I don't think that has improved a lot. I don't think the credit growth has gone up. That's what my memory tells me. So I think that's a problem, right? So banks have rates are historic low. I have this is the lowest policy rate I have seen in my career, and probably this is the lowest policy rate ever in India. So, and banks have a surplus liquidity of 12 lakh crores, which is huge amount of money, right? Which despite all of this, the credit growth has been very poor. Now we all know the problem. The problem still continues to be the recent history of NPLs, and banks are not very comfortable in and of course then we had this pandemic where also there was some kind of a restructuring which happened on the loan side. So I think that is a problem, and that problem is still not gone away despite whatever the easy situation and now we're going to get into a little bit of a tighter situation. So because the lower rates and liquidity didn't do much to bank credit, I'm not very sure what to make out what will happen in when the rates go up a little. Now, coming to the interest rate sensitive sectors, which is real estate, specifically, you can think about the end, some of the consumer sectors as well. Uh, as I said, right, I think that is a more of a function of, that's a more of a function of liquidity rather than the absolute interest rate. Mortgages are very low, and we are seeing decent impact in the real estate. Now there could be multiple, right? You look at the real estate, which has started doing very well in the last 1 year or so, right? And there is a decent amount of demand we are seeing everywhere. One is, of course, that the real estate prices have either gone down or has been stagnated for the last whatever 7 8 years. So, in terms of the pricing itself of the properties, they are at reasonable level, right? Secondly, the mortgages rates are also been very very low, right? You can get a housing loan at 6.7% right now or whatever. I'm probably lower as well. So I think that more, the loan rate may go up, but having said that, if say RBI increases rate by 100 basis points, I don't think the loan rate will go up by 100 basis points, right? Because the banks have surplus liquidity, the credit growth is still poor, so there will be banks. The competitive pressure in the bank will make sure that because they want to increase their balance sheet, because they have a lot of money, it will not follow in the same way as the policy rate. So I think there will be some impact, but I don't think there will be the lot of impact on the interest sensitive one. Again, the thing to watch out is liquidity. If liquidity tightens, which I can't see in the foreseeable future, that will have a more of an impact, right? Because this tight liquidity is what created issues for NBFCs. In the last 2 3 years, when NBFCs were not able to get money, it was because of the tight liquidity situation, and they were not able to borrow money. When easy liquidity is there, it should not be a big problem.
Cool. I'll ask my final question, and in that I'll also give the audience to request to become a speaker. If you are a regular speaker in one of my rooms, then I'll pull you up directly. If not, please send me your question. Via DM. This is just so that we can filter out trolls, and then I can pull up people one after the other. We have a limited time. The room ends at sharp 6:30. So please try and be quick about it. Yeah. With that, my final question is, um, in such in a scenario where growth is going to move up going forward, do you think that this rising rate environment will be from a macroeconomic picture for India, um, won't pose much of a problem because of the quantum of economic growth we are expecting going forward?
So, see, let's look at the again, right? The rate cycles in 2000s, right? And from 2003 to 2008, the economy and the market continued to do well, where actually the rates were rising everywhere, globally and India, right? In US, it went up to 5%. I don't remember where it was in India, but I'm sure it was probably, the lows in 2003 was around 4%. Probably it went up to about 8 9% in India in 2013 as well. So it didn't have much of an impact, right? Because see, the there are many things which goes into economy, and interest rates is just one of the piece, right? Now, what always have an impact is that when you have an outsized rate hikes, of course it will have an impact. The what has a maximum impact on the economy, particularly for India, when actually RBI tightens liquidity, and they've done that, right? And they why they do that? They've done that couple of times. All in most of the cases, it was to defend the currency. It was to defend dollar INR, right? Whether it was 2013 or even earlier as well, it was to defend the dollar INR. So RBI usually typically tightens and then of course they tightened the policy rate in 2000 when they went into this whole inflation targeting mechanism to bring down the inflation. They tightened the liquidity, and they brought down the whole system. What I am saying is that right now we have 12 lakh surplus liquidity, and when Raghuram Rajan and then the government implemented this whole monetary tightening, the monetary policy committee, they actually took down the liquidity deficit, where banks had to actually borrow money from RBI, and that's how they. So I think that will have a more of an impact. Again, I'm bringing this point again and again about liquidity because that is more important to understand, and people outside fixed income market don't tend to see that. Because that impacts the banking system much more, and their propensity to lend money goes down when actually they themselves don't have surplus money. So I think that is more important. Inflation rising rate will have some impact, but will not have that much of an impact. And at least in the recent history tells us. I mean, you're as I said about 2000s. I mean, the credit markets were doing very well. Rates were going up at the same time, and of course, the equity market doing well. So I think for equity market, key thing is to watch is always most important thing to watch is bank credit growth.
Yeah, absolutely. I think I've also been watching the credit growth, moving forward, and I think even the bank heads have spoken about the fact that it'll only pick up around FY 23-24, because as the capex cycle picks up, and also as wages go up, wages have gone up, and IT haven't gone up that much, everywhere else. But yeah, I mean, we can talk about that offline later. Um, there's one very specific question which is from the audience, but the person who's asked the question can't come up right now, so I'm asking it on behalf of him, and then we'll move to Parvez next. The question is that a lot of companies in the US stock market are currently unprofitable. Some of the companies in the Indian stock market are unprofitable. How much is the going up in rates going to affect companies where profitability is still 4 5 years away?
So the market has been very correct in that, right? So I mean, I'm not actually a hardcore equity guy. You guys are more. So I mean, it's all about cash flows, right? So the longer you project the cash flow, and because the companies who are not profitable, and the fact that market value them, the market is expecting them to have some kind of a large size cash flows in, say, 5, 10, 15, 20 years down the line, right? I mean, look at Tesla. What happened? They're now cash flow positive, but they were not in the first 10 years. So in case of an unprofitable company, the expectation is that they will have cash flows because they're going to become so large, but they will have cash flows later on in their life cycle. And when you discount them, right, because it is long dated cash flow, it becomes the much lower the rate, the value of the cash flow increases. So very rightly, the impact of uh, interest rates hike will be larger in those companies. And in case of those companies, the history will not be a reflection of what it is, because there were no such companies existing 10 years, 15 years down the line, right? I mean, hardly any unprofitable company would be able to even list in any market anywhere in the world. I mean, so right now we call it imaginative company. You have to increase your imagination to invest in those companies. So, so of course, they will have a large size impact, and that is what has happened, right? I mean, a lot of bloodbath has been happening in US. I mean, and I'll just take few names which could be familiar with to people, right? I mean, for example, Zoom. Right? Zoom went up to $600 in October, November last year. Right now, it's trading at 180. Right, so that is the kind of impact on and it's a great company doing very well, actually now generating free cash flow. Look at the Peloton bikes, went up to $200, trading at $30 now. Look at Freshworks. I mean, Freshworks is not a very I mean, it's not that they're very totally unprofitable, but because most of you must be familiar with Freshworks. It got IPO'd at about 45 or 36, I think, and 36 went up to about 45, and right now trading at 25. So market is very right, and they're punishing for any increase in probably they got the benefit of having too much of a value because of zero interest rates and market projecting zero interest for too long, and now they're saying that because the interest rates are going to go up, okay, so they're bringing down the value. So the net is that for all those companies where which is a factor of imaginations, and the cash flows are expected to come in much later in their life cycle, will of course get punished much more because of interest rates also. I mean, they might get punished because of many things, but interest rates also they will get punished for.
Thanks, Raj. That was super insightful. Parvez, you can go ahead.
Hey, Raj, good to be back with you again. How are you doing?
Hey, Praveen, how are you doing? Thanks for coming in.
Very well, very well. Fabulous insight on the macro level, both economy, banking, etc., US and India. And Raj, wanted to ask you something very interesting that I notice is, the FIIs have brought in a ton of money into the Indian market last year, and the statistic that I've seen recently is that all that they have brought in last year has been pulled out this year. And if you really look at it, this is something that I've been following from the 16th of last month, November, and today is the 17th. Every single day, except maybe one day, the FIs have pulled out. And I'm wondering what the reason would be, because just if you could answer that, and then I'll follow
Sure.
up with another question about it.
Raj, I don't
Can't
think
hear
we can
you.
hear you.
Can't hear you, Raj. Still can't hear you, Raj.
I'll
He's
invite
he's
Raj
connecting.
back.
He's connecting now.
Hey guys, can you hear me, Parvez?
Yeah, now we can hear you.
Okay,
Yeah,
sorry,
yeah.
I don't know what happened. I got a call actually on the phone. So
Yeah, that's what happens.
yeah, and they got to figure that out. So what I'm saying is there are two parts of the FIs. When we look at FIs, right, they're not a kind of a uniform players, right? So one is, of course, there you will have long dated players like pension money and real money kind of money, which is mutual funds, which is long dated money, and the other one is hedge funds, right? So hedge funds are hedge fund. I mean, we know they can do one thing today and one thing tomorrow. Having said that, while US markets have done very well, while India markets have done very well, emerging markets have done very poorly overall. And thanks to China, predominantly has to be thanks to China. So people who are mostly into when they trade India, I mean, you typically trade emerging market broadly also, right? I mean, while some people have a mandate to trade US markets only, but a lot of people who trade globally, either they will have a global mandate or typically you will find that they will be part of emerging market portfolio. So they trade emerging markets. And because emerging markets have done very bad, and because we are coming towards the end of the year, I mean, everybody, you typically behave in the same way. They have to protect their PNL. And where does the PNL come from? India, right? Because India has done well. So uh, I have lost money in China. I've lost money in Brazil. I've lost money in Argentina. All of them, by the way, are down for the year, right? They're down for the whole year 20, 25, 30%. So I've made money in India. Let me protect it. So I think a bulk of it could be that. The second reason, of course, could be that India always looks expensive, and India is expensive right now. So that is a second reason. Third reason is that we only look at the secondary market in terms of when we look at inflow and outflow, and probably we need to add also the buying they do in the primary as well. So my understanding is that, and I don't have the data right now, but my understanding is that if you add all the buying which they've done in the primary market, probably they've net bought.
Hmm. Raj, there's another thing also. I mean, yeah, I understand that when these guys when the FIs come into an emerging market, yeah, there is a certain amount of. I mean, India has been on a super bull run, so they've made some phenomenal profits if they've come in right at the bottom of the COVID, etc. And there would be, of course, there would be profit booking, and it's coming to the end of their financial year also. And at the same time, Thanksgiving, Christmas is usually everybody gets into the holiday mood, so they might be wanting to pull out even before Christmas creeps in. But if you really look at the interests and the cost of funds that are available in America, it still is a very, very attractive thing to go to emerging markets. And I just wanted to ask you that, yeah, if this is the reason why they are pulling out, it's a fair reason. And once they do their profit booking, maybe they'll come back here. But if since we're talking about the global economy and liquidity, etc., there's been a huge, of course, whereas there's an upward trajectory for the Indian market. China, on the other hand, being again another so-called emerging market or now a full-fledged matured market, has had a tremendous drawdown. So, do you feel that these funds would be moving into other markets like China, etc., and they would wait for the Indian market to settle down before more funds come in? Do you feel that's going to happen?
I don't think, given so much of uncertainty which is happening in China, while it looks very cheap, I don't think people are selling here to buy in China. They don't work like that. I mean, typically I've seen that people chase returns, which is what happens everywhere. People chase returns, right? So if China is not doing well, they will not. And frankly, if I look at me now, hello.
Yeah.
Yeah,
Okay,
yeah,
sorry again. Some call came. Yeah. So I'm saying is, if you look at, I look at China, and I speak to many fund managers. A lot of our friends here. Um, there is no clarity yet in terms of what the Communist Party is thinking, how things are going to work out. I don't see you will get a clarity about China till the next, CCP meeting in November of 2022, when President Xi is expected to become again re-nominated as the president. So I think the uncertainty in China is going to be there for another 6, 7, 8 months, and that is what they all. While everybody knows it's cheap, there are many things happening. This whole U.S. China U.S. is now again came out with a list of blacklisting some of the Chinese company. Now some of the Chinese company have to delist from U.S. They're trying to list in Hong Kong. There are too many things happening. I mean, China is untradable right now, I would say, and that's the general sentiment. So I don't think any money. To your question, I don't think the money is moving out from India to China. I think money probably must be sitting in sideline. Might have seen some redemptions. I have no doubt in my mind that they will come back, and India. They've always done that. They will always do it. So in my thinking, I have never found. We always used to think, and we have probably a historical way of thinking that these guys knows more than us. I don't think they know more than us.
yeah. What is very interesting also is whilst they were selling, the DIIs and the retail market was absorbing
But that's the power, right,
all the
Parvez?
yeah. That's beautiful.
Yeah,
That's very healthy.
11,000 crores
So,
comes in a month in
yeah,
SIP. I remember Rakesh
yeah.
Jhunjhunwala used to say that Indian retail, and we all know Indian retail is still very underinvested. And this is long term money. I mean, we need to. The beauty of the market only comes when it becomes more and more domestic, not when you are
One
at the
lakh
mercy of.
crore, if I'm not mistaken,
Sorry.
Raj. 1 lakh crore.
No, eleven
One
thousand
lakh
per
crore.
month. I'm saying 11,000 per month.
So for the
Yeah.
annually, it was 1 lakh crore.
Yeah, so I somebody
Phenomenal.
asked on our multiply platform about this whole FII thing also, and I responded to him saying that FIs used to matter earlier when they were larger than everybody else. Now, no more, right? I mean, they're being matched equally on the other side by the domestic investors, and probably in next
Yeah.
1 or 2 years, the domestic investors will overtake the FIs, so they will become much much smaller, and their impact on the market actually will just go away. I mean, you look at You look at the FX, right? I mean, the kind of, you mentioned about the kind of selling they've done. I mean, dollar INR frankly has not moved much. That's the first
Correct.
market you will see a big impact on. You guys, whenever you want to watch an FI impact, you should watch dollar INR, not equity, because that is where the big impact is, because they take the money out in billions of dollars, and market, there's a demand for dollar, and dollar INR should typically go up. If dollar INR USD INR is not moving much, means that it's nothing.
Awesome.
Great, thanks.
Let's move on because we're very short on time. Raj, we've actually got four people lined up to ask questions. How many of those questions will you be able to answer?
Let's take all four of them, and then we'll stop there.
Okay, sounds great. Cindy Chokro, please go ahead.
Chris, actually, I don't have a question. I had to give a few perspectives, if you allow me to give. Otherwise, I don't seriously have a question, but I have few perspectives. My perspectives on the credit
Happy to
growth and
hear.
the.
Go on. Happy to hear.
Uh, okay. So, first of all, Raj sir had spoken about the banks and the liquidity. So, I wanted to share that today we are at the lowest point of the NPAs. Like you would see in quarter four, SBI reported 80% rise in their net profits. So you can just imagine that it has already exhausted its NPA. So we are at a, if you imagine the business cycle, we are at the lowest point where the capex will start beginning. So the NPAs are at the lowest, and we will start seeing credit growth from here. That is one part of the credit growth. The second part of the credit growth would come from the PLI schemes. There are government has allotted 2 lakh crores just to PLI schemes in 13 sectors. So you can just imagine the capex that is coming from there too, right? Third liquidity or the credit growth would start when government starts its spending. So if you know about this Gati Shakti project, that this is one of the projects that the government has, and it is worth around 1 lakh crore. So that is where the government spending would also boost the credit growth. That is on the credit growth part. The second part of okay, fine. I mean, I would restrict it to this. Real estate is fine. That would be a really niche comment. So yeah,
No, I think that's a great point, and I would agree with you on that. That that's why I don't see I don't see the risk of interest rates impacting, because we are actually at the lower point in the credit growth, and actually credit growth should actually only improve from here. So we should see a more positive from that.
One observation that I had, I guess, yes, Parvez sir said that FIIs have been net sellers in last few days or so. But FIIs, if you go to see in cash segment, they have been selling since March. So there was just 1 month in maybe September or something where they had a net purchase of 900 crores or something. Otherwise, always since March they have been sellers above of 2,000 crores or something. 2,000 crores, yes. So I don't think that we are these days dependent upon FIIs. We are like self-sufficient these days. Yeah, that was from me.
Thank you.
Awesome. Thanks. Prachiti, you want to go next?
Thanks, Krishna. Hi, Raj. So, since you were talking about USD INR and emerging markets, my question is, have you seen or noticed any correlation between the dollar index, emerging markets, and how lately, earlier India was clubbed with emerging markets, but lately I think India is stands on its own. I just wanted to sort of hear your opinion on or your observations on this trend.
Yeah, I mean, see, it definitely looks like that India is not. Dollar INR has not been behaving in the same way as the other emerging market, but so is dollar China, by the way. US actually dollar China is CNH has done better despite China economy going through whatever shit they're going through, but they've done better. So. Uh, the whole while the dollar index is all G3 G10 or the it's the G whatever top 5 6 economy, and where India and China are not part of that. I mean, India and China will be part of the something called ADXY, which is Asia Dollar Index. And I would say the DXY, which has gone up, is frankly because of the poor euro and poor pound, right? I mean, they're at worse. I mean, see, exchange rate is overall relative. which country is doing better than the others, simply, right? And both Europe and the UK have their own problems. So I think what DXY is telling you that US is doing better than them. Within emerging market, frankly, and this is what my last 10 years observation has been, that Asian emerging markets always do much better than the rest of the emerging markets. So while you will keep hearing problems of Turkish lira or Brazil real or Argentina peso, whatever, Mexican peso, whatever, the impact of that on Asian economy has been always very lower. So the Asian economy, Asian FX, Asian interest rates, I mean, are much stable than the rest of the EM. So I think the EM as a concept is becoming more and more regional in nature, I would say. But having said that, within that, I mean, I will not say ki India is standing out. I mean, and ultimately, all these things move together. India is doing better, of course, but so is China. So it's more a nation region which is much more stable.
Thanks, Raj.
Thank you.
Cool. Let's go to Siddhant and then Accidental.
Hi, sir. So my question is related to startup space. So P2P lending and BNPL have picked up quite well around the world and also in India. So will the increase in rates be disastrous for fintechs who are providing these services?
I mean, my understanding is that the kind of rates they charge, they are insensitive to policy rate movement, right? They charge so high rates. I mean, BNPL, while it may look like that they don't charge anything, but they charge in the fees, and of course P2P lending is a different animal altogether. They're charging 12, 15, I don't know what percentage they charge, but their sensitivity to the policy rate movement of 100, 200 basis points is not there.
Okay. Thank you, sir.
Thanks,
Accidental?
Krishna. Hi, Rajkumar sir. My question is, do you see any direct correlation between liquidity in the market and sectoral rotation?
I actually don't have an answer to that, but my gut feel says that it should not be. I mean, liquidity in the which liquidity are you talking about? Liquidity within the equity trading or liquidity in the banking? Which liquidity are you talking about?
And see, I mean, hello. Liquidity as a whole,
Go on.
when the corona crash came, more of liquidity was pumped into the system.
Okay, so you're talking about system. That's called system liquidity, but I am not very sure there is any correlation between them. I think sectoral is more about cycles. Whether commodity is doing well or not, whether if real estate is doing because of whatever reason, then you have defensive sector. I mean, I'm not a sectoral expert at all, but my gut feels that there should not be any correlation.
Okay, thank you.
Thank you.
We've got Sahir and Gurmeet who've joined. Sahir is a moderator with us at DI, and Gurmeet is a renowned investor. I just want to see, Raj, if we can take one question from them.
Sure. Go on.
Hi Raj, thanks Krishna, and hi Raj. Just wanted to know if you have any thoughts on the inverse correlation of the DXY with the Nifty. I joined a little late, so I'm not sure if you've covered that, but if you could, if you could elaborate a little on that.
Sure, Sahir. I mean, frankly, I ran the correlation between dollar INR and Nifty, or I don't know whether you use Sensex or Nifty, whatever, same thing. We found that correlation also poor. So if dollar INR and our own equity market, our own exchange rate doesn't have that much of a correlation, my gut feel says that the correlation between I have not ran the correlation between DXY and our markets. We have ran the correlation between US markets and our markets. That correlation is also poor. So my sense is the correlation will be poor for the DXY and Nifty as well on a medium term basis, right? I mean, on a day to day basis, I mean, whether because DXY has gone up overnight and because of that our markets may open weaker, that may be very high,
but then you have to, you have to look at that correlation only, that what is the correlation between our market opening versus DXY. That's a very different ball game. But on a medium term basis, I would say that the correlation will be poor.
All right. Thank you. Thank you.
Thanks, Ed.
Hi, Gurmeet. Do you want to go next?
Yeah. Hi, guys. I was just happy listening to your views. Really, didn't have any query. To be honest, so was just happy enjoying the discussions on various things. And when markets correct, all correlations are thrown to the dustbin. Every time there is a every time there is a hindsight, and we are able to draw. So I'm happy listening. In case anybody wants to ask something, I'll be around for some time.
So
Thanks for coming in, Gurmeet.
So maybe after Raj leaves, we can do a bit of Q&A with you as
Absolutely,
well.
absolutely.
If that's cool with you.
Absolutely.
Awesome. So I think with that we can conclude the discussion that we've had so far around macro and liquidity. I just wonder, we don't have the pin link feature yet for some reason, but I want to ask everybody in the audience to go download the Multiply app. It's an awesome social network just for investors, and whenever people talk about stuff, they tag companies. You can simply tap on that company and go check out the financials of the company. They've also got an investor portfolio functionality where you are able to go in and see who has what, and if you have a question around a particular company, you're much more likely to get an answer from someone who's holding the company. Raj is actually the co-founder of Multiply, and Abhishek Murarka, who a lot of you know from Twitter, is the VP for community. It's been absolutely a pleasure to host you, Raj, on this Twitter Spaces. Please, guys, go follow Raj both on Twitter and on Multiply. He puts out some really interesting content, and we definitely plan on having him here for more sessions. Hopefully, this can become a quarterly feature.
Thank you, Krishna, and I really enjoyed coming here. Probably my second or third Twitter space, but really enjoyed. Happy, happy to share my experience with you all. Having spent so many years in the markets, both in India and also looking at the Southeast Asian markets as well. So happy to share my thoughts wherever I can, where can I be value. And I will see you around both on Twitter and on Multiply. We are very excited about what we are building at Multiply, and it's actually building for you guys. So please come and be part of it. Do share your thoughts, feedback. We are, the as we get more and more feedback from users, we know what they like and what they want, and we are happy to take that into into what we are building. So thanks a lot, and keep enjoying this conversation, and I'll see you around next time.
Awesome, awesome. Thank you so much, guys. Also follow the other speakers. Parvez, Gurmeet, of course. Sindhi Chokro, Siddhant. They've all come out. They've all shared their knowledge here today. Siddhant and Parvez were actually the winners of the Multiply stock pitch contest, and they actually came out on a clubhouse room and shared a lot of data. Also, keep up with my handle. I'll be hosting rooms like this between 2 to 4 times a month, uh, and try and bring you some of the most interesting names from the investing space. With that, I'll just sort of welcome Gurmeet. Hi, Gurmeet. What's happening? This is my first time interacting with you.
Sure. No. So thanks, Krishna, for the DM and having me. I think the market obviously has this unique ability to take your breath away. Every now and then, and I personally think we were all having it too easy for last few months, if I were to say. I think what stood out for me, and while we can keep analyzing in hindsight, I think what has stood out to me is the resilience which the market has shown on this aggressive selling. I think last 40 days, today's sell figure is 2,100 crores. I think FIs have sold almost 90,000 crores. Uh, in last 40 days. If you that's almost like 11, 12 billion dollars, and despite that, the Nifty still from the peak is down about uh, about 8-9%. While obviously there have been pockets where the correction is deeper. Secondly, if you remember in March 2020, when the sell-off happened due to COVID, on $8 billion sell-off, we went down 25-30% because the sentiment was so low and there was hardly any buying by DIs and retail. So my own sense is that some corrections are healthy. Markets had become too frothy in few pockets. Anything and everything in IPO was going up for no reason. Companies were using new fancy terms like price to sales, uh, and various multiples which were being invented to justify. And and I think market has their own ability to, it's a great leveler. It brings you down, when you think that you're having it all by yourself. So my only request is that every past correction, there is a saying, has been an opportunity. Every current correction looks like a risk. uh, Volatility is integral. 10% once a year, 20% once in 2-3 years, and more than 40-50% once in 6-7 years will happen. The names will change. It will be Lehman crisis, it will be Fed taper, it would be COVID, it would be dot-com bubble, it could be a Harshad Mehta scam. Couple of times in a decade, you will have these kind of black swan events which will take your breath away, and corrections will keep happening. The 2-3 things you should be focused on is: A, the economy is on great track. So you will possibly see 8-9% GDP growth with 5-6% inflation. So nominal growth will be 14-15%, which means that you will have a very strong earnings growth next year. So Nifty, as we speak, is after this correction, you are getting it at 24 times trailing and about 19 times forward, 20 times forward, right? So we are not very expensive or in a bubble zone what we were at 29-30 times multiple. Number two, any high frequency data you look at, advanced tax has been robust. GST, we've had record collections. You see the mobility number, you see the airway bill generation, you see power consumption. We saw the best ever Diwali sale. I can go on and on. All high frequency indicator point towards economic activity uptick. So as long as the growth is coming back, any correction, would in my view would be an opportunity. At the same time, anything which has fallen doesn't mean that it's become cheap, right? So you have to differentiate between price correction and value in these kind of markets. There are plenty of spaces where I think the correction has been a little unfair, considering the numbers which they posted and are likely to come. Private sector banks, I personally think that they've seen, so Bank Nifty is down 7,000 points. So you're actually getting banks at 12, 13, 14,000 Nifty levels if you were to look at it. Secondly, a lot of these API cramps name, we've seen healthy correction of 20-30%. Even something like a Divis is down 18%, right? Uh, Everything in the specialty chemical was going up, as if only India will be making specialty chemical. So there's been healthy correction there. So I think 2022 will be a year where you will see now differentiation. It will not be a beta year, and that is where the men will get separated from boys. So keep your eyes and ear open. If you have liquidities, you can start shopping, and if you don't have, just sit tight. We have seen the biggest drawdowns don't last long. So just be prudent, and some rationality is being restored, and I think it's very healthy for the markets.
Awesome. Thanks, Gurmeet. That was like a full overview of the market. You ate up my 2-3 questions as I was having them. But can you tell me a little bit about what you think the sectoral rotation is going to be like? Moving in from 2021 to 2022.
Sure. So, as I said, last year was almost a beta year. If you threw a dart in the sky, chances are you would have hit a star, right? You would have been really unlucky. So I think from here on you will see differentiation. See, so market, if you see today, IT stocks are up, led by the Accenture results which came in last night. I personally think that technology is in a is in a good medium term bull phase, and whenever you adopt technology, the adoption by the companies is a 4 5 year process. It's not that you spend technology in 1 quarter and shy away from it. So if you see tech spends, there's a very nice report Motilal has come up with, and I, if I have the link, I'll try and share here, where they are saying that technology spend was 3% of sales. It's gone up to 5% of sales. So it's obviously anchored by cloud, but it's also being held by a lot of digital services, your Internet of Things, the SaaS platform spending, etc. In fact, when we meet clients, we see even some of the traditional companies, adopting Salesforce, adopting CRMs, data analytics. So technology it's actually becoming a core to the business. So I personally think that we will be in a good run. Obviously, you have to be careful in not overpaying 60 70 multiple on IT services company, but if you can do a staggered investing, I think that is something which will be very secular. Second sector which I think is looking very very good is this financialization of savings. Just to give you an idea, we have 7 crore demat accounts. We've opened 1 crore demat accounts in 100 days. Chances are you will see another couple of crore demat accounts in the LIC IPO itself, right? So just to give you an idea, LIC has 30 crore active policies in place. Your number of demat accounts are just 6 7 crores. So I think there is a long runway here, and anything to do with asset management, depositories, RTAs, I think will do well. I'm also seeing a very very good recovery on housing side, especially even in tier 2 tier 3 towns. So I like this entire building material space. So uh, at 6.5% home loan, technically a 30 40 lakh home loan, if you are at the highest tax slab, is virtually free if you do the maths. So it's actually better than paying a rental yield. And so anything to do with housing, I think, with whether it is cables and wires, whether it is tiles, sanitary maker, some of the fast moving electrical good maker, I think hopefully should be in a good run. Again, the disclaimer being some of them are overpriced, so you have to be a little careful. So one broad thing is that do not overpay. Do not fall in love with the name. I think that we have this habit of making heroes out of portfolio manager and making some stocks as invincibles. I think that strategy can backfire very badly. The best of the stocks can go through very very lean phases if you overpay on them. Lastly, I think pharma outsourcing to me is where IT outsourcing was 20 years back. I think what you will see in next few years is huge China plus one opportunity playing out, and some of these stocks have really corrected because this business is very lumpy. The molecules take time to commercialize. 1 quarter order getting displaced, the revenue numbers will get so just to give you an example, DVs for example is doing a 5,000 crore capex. Their total capex for last 20 30 years was 1,500 2,000 crores. So that's like 2.5 3 times of what they've ever done. So I think the differentiation will come, and you have to lower, sober your return expectation. Not every year will be 40 50%. So forget about 2021, right? And if you are seeking 12 13 15%, I think there's still a lot of opportunities available right now.
Awesome. Just I have one question, and then after that, if any of the current speakers have a question, you can unmute and ask the question. Anybody who wants to ask a question, if you're a regular here, please just raise your hand. I'll pull you up. If you're not a regular here, then please DM me your question. We need to do this in order to filter out trolls. Uh, so my question was, because you mentioned Divis and the 5,000 crore capex that they're doing. Will that more than double their net block?
Sorry, would that double what?
Their net block.
Okay, so I'll tell you. See how this works is that everything doesn't happen, on a linear basis. So if you track DVs, their custom synthesis and generic mix is about 40 60. So if you for example, so they are basically a high volume API player. They largely make they have a 30 molecule portfolio, and they are I think leaders in 18 out of 30. One of the so essentially basically there are three segments. So one is generic, which is generic API. Second is custom synthesis. Custom synthesis is basically nothing where you are actually doing a contract research for a MNC company or making doing contract manufacturing for them. And third, which is a small segment, is nutraceuticals, right? Where which is currently so one of the API DVs makes, just to simplify it because there are a lot of people here in the call, is molnupiravir. Molnupiravir is the API used for making COVID drug, right? So DV's it makes it for Merck and some of the other names, and it started manufacturing this particular API across all the three production lines it has. So a lot of the numbers will probably play out. Also, it has great chemistry skills in terms of adding value to late life cycle studies, etc. And this is a very complex vertical. Once you are good at something, the approval process is very long. But once you get in, the next guy takes another 4 or 5 years to get in. So a lot of things you have to identify what is going into the development stage, and then get in there and then reap the benefits when it gets commercialized. So I think Divi's also has a ability to do complete backward integration for all the new introductions it has done in the past. And so this is something I don't want to make it a Divi specific discussion, but as I said, there are 2,000 odd molecules. So Divi's is in one. There is Laurus, there is Indeco, then there are smaller ones including Newlands of the world. So it's I think the entire sector, in my view, should do well. And all these companies are 3-4 decades old. Nobody is like a new kid on the block, and some of them have. So just be mindful of companies which have good regulatory track record. Companies with bad track record with US FDA and drug authorities is something you have to be careful about. That can completely derail the entire exercise.
Makes sense. Makes sense. So what you're saying basically is, because there is a huge pipeline of products, and they are contributing to a bunch of different therapies. It's probably looking at it in terms of in terms of what their current capex spending is, versus all existing machinery might not be the best way to look at it, but instead to focus on the areas where they have a lot of expertise, and they've been able to enter and create a niche, and to focus on the competitive advantage and how difficult it would be for other players to get in.
Sure, absolutely.
Cool. Accidental, did you have a question?
Hi, Gurmeet, sir. I have a small question. Like with the entry of LIC in the insurance sector, how you see the, I mean, as a insurance as a sector will grow, or the existing listed companies will, I mean, how they will be moving from here?
Sure, I think excellent question. I personally think insurance sector is where private banks were 10, 12 years back. LIC currently has almost 67-68% market share, maybe 70% plus in terms of number of policies, and around 65% in terms of the premium which we call. So what we are seeing here is that a lot of the private players are, the industry is growing at a healthy double digit rate. Second, the private insurers will keep grabbing market share more, right? Which is what happened with, if you remember, PSU banks 10 years back had a 75% market share, right? And today that number is down to a little over 50%, right? Banks, the banking sector grew because that's a proxy to the economy, and then the private banks kept getting market share. So for example, if you see last quarter, the credit growth was only 6%, but ICICI had a credit growth of 19%. HDFC had 16%. So industry का credit 6% बढ़ा, 7% बढ़ा. The private bank in that grew 16-18%, which means it grabbed more market share. I think with the exception of SBI, again most PSUs grew less than that, 6-7%. So coming to insurance, I think one thing you have to track on insurance is not just the premium growth. You have to track this. There's this term called VNB, value to new business. it's a measure of profitability for insurance, which means how many new policies are getting added, and that VNB margin adds to the profitability. So HDFC Life, for example, if I were to take just one name, and again a disclaimer, not a stock reco, the VNB margin growth and the VNB growth has been upwards of 24-25%. Right. The second thing you need to track is persistency ratio. Persistency ratio is policies which continue after a certain period, because insurance is back ended. The policies become profitable, once you pay a certain X number of premiums, because the first year premium and all, a lot of money goes towards commission and other expenses, right? So anybody with a good persistency ratio will do better over the long run. Currently, a lot of the insurance companies have been hit by high claims. They had to make a lot of provisioning, and that's why there is a near-term underperformance. The penetration of insurance remains low, and all the top three private insurers, which is HDFC, ICICI, Pru, I think will do well. HDFC, particularly in persistency, is the best. So 13-month persistency is almost 91%, and 61-month, which is policies more than 5 year, the persistency is almost close to 60%. So that is one parameter you need to track, because that affects your underwriting profits.
I think we lost accidental.
Yeah, I think so.
Do any of the existing speakers have a question right now? If not, I'll start pulling up some of the others as well.
So Krishna, I can take one more and then I have to rush. And
Okay, Gurmeet sir, I'll ask you. I mean, this is for all the newbies who have started investing in equities in last 12 to 18 months, and they have had stellar performances, but they don't know how equities behave, or they haven't experienced how equities behave in long run. Coming back to the point that where you said that India's GDP growth would be around 6 to 7% on a minimum basis, and inflation would be around 5 to 6%. So that brings to around 11 to 12% of nominal growth. That would be a nominal growth in the index itself, or index should reflect that much. What equity returns should we expect in a longer run, or what CAGR should the investors expect in a longer run, say for a period of 5 to 10 years from equities by personal investing?
sure.
To keep a benchmark.
Yeah, I think that's a good one, and I think why it is also a good query is because of late, lot of funds, lot of portfolios that struggle to beat the benchmark. More than 2/3 of them. So my sense is that, and I could be wrong on this, is that we are at a very very huge inflection point, and markets work in cycles. So if you see the 90s, lot of reforms happened, and I'll spend 2 minutes on it just to make my point. In 90s, lot of reforms happened, but in 90s you also had the Harshad Mehta scam, the Kargil war, the Asian financial crisis. So in 90s the index only grew 2.5x. A lot of the reforms which happened in 90s, and then later with Vajpayee did in terms of golden quadrilateral project, etc. Chidambaram came with a dream budget in 97 reducing taxes. The result came in the next decade where index grew 5x. Again, we were very slow on reforms. So 2010 to 20 index again only grew 2.5, 3x. Uh, so then we did GST, we did RERA, we did IBC, we are doing PLI schemes. I was recently looking at the Bharat Mala project. I think that's massive. The kind of expressways and roads and the dedicated freight corridors we are building. My sense is this decade will be better than last decade. It may not be a 5x decade, but this could be a 3 to 4x decade in my view. uh, and that probably coincides with about 13 to 15% kind of a range, and which is equal to nominal growth, because I expect the GDP growth at 7-8 and inflation to be a little higher. So I think anything around 13 to 15 you should be very very happy. Reason being that fixed income will have a very tough time, considering that inflation is sticky. In the process, and I think do a combination of portfolios. I think I find this entire debate of generating alpha, stock better than MF, PMS better than MF. I think this is a very very overrated debate. If you can devote 2-3 hours every day, you can track companies, you can quarterly review their results, you can read annual reports, you can find time to attend spaces and earnings call, you should have a larger portion of direct stocks, right? But don't have 50-60 stocks. There's no point having, because you can't track. I mean, I can't track. I personally, my 80% wealth would be in about 15 stocks. If you are more passive, you don't have time, you're working, or you're busy with your business or profession, and you're very, very passive, then a higher portion towards should go towards passive portfolios, MF and PMS. So it's each to his own, and do not try and copy anyone. I mean, just because somebody's made great returns, I should also buy the this borrowed conviction will lead you to nowhere. So if you have that 13-15% expectation, chances are you will have couple of years where you could get a bit of a delta, and this could be better. Also, when you get drawdowns, right, in the market, you need to make good of it. This is unfortunately one place जब sale लगती है तो लोग भाग जाते हैं, right? And so everybody wanted to buy Bajaj Finance at 8,000. Now suddenly at 6,800 you will have doubts. Everybody wanted to buy DVs at 5,400. At 4,500 you will have doubts. HDFC Bank was the darling 2-3 years back, right? And the stock hasn't done anything, you have doubts. I'm just giving an example. I'm not saying these are great stocks. I'm saying that best of the stocks can have more than 50% drawdown. Infosys 5 times has fallen more than 50%. 5 times in last 20 years, right? DV's Labs, we were discussing such in length. It fell almost 50-60% in 2016, if I'm not wrong, when it had an adverse US FDA inspection. Asian Paints was $1,300 during COVID, right? So I'm saying that the best of the stocks, the bluest of the blue chips, can have drawdowns, can have bad periods, can have lean periods. A lot of you may not be knowing Hindustan Lever from 2001 to 2009, in the best bull market India has seen, Sensex became 4 to 21,000. 5 became 5x. Hindustan Lever was hovering between 250 to 300, gave zero returns in the bull market. But then from 2009 to 19, it became 10x. Right? So equity, have a longer horizon, think in terms of 5-10 years. Second, some part of the portfolio will underperform. Do not get the train ka aakhri dabba aap nahi hata sakte. In fact, some underperformance is the reflection that you are diversified, right? As long as the entire thing is right, and get the combination right? And if you have liquidity, choose these dips wisely. If you don't have, just let it go. Cricket mein kehte hain na, kai baar you just need to survive on the pitch. The runs will come.
Amazing, Gurmeet. It's almost like you had the answers to the questions as people were thinking of them. This It's been fantastic to host you. In fact, I would love to connect offline and plan a proper space where we can go over your investing philosophy, your stock selection, how you look at portfolio allocation, position sizing, all of that. We've done it with Tariq. We've done it with Samir Arora. We've done it with Safir Bhai. Would love to have you as well.
Sure, would be a pleasure, Krishna. Thank you, everyone. Have a good weekend and happy investing.
Awesome. Thank you so much. I'm going to keep this room open for some time in case, people just want to hang out, talk, chill. We're all here. I'm also pull up everybody who had a question and wants to talk about anything, so that we can just have this as a free flowing investing discussion for some time. And anybody who's come up now can just unmute and speak. Hi, expert voice, Chintan, Indian rookie, Adolf. I think. Yeah, go ahead.
I had one question, if anyone can answer. So I was just checking out Multiply, the website which Raj and Abhishek have founded, and I was just checking out the portfolio of Raj. I don't know if he's still here, but I saw one of the company named Cosmo Films. I don't know if anyone is tracking it. So I after looking at the share price, how it has risen after COVID, I saw the revenues and I was curious to ask this question. So I'll just give the brief about the financials of the company. So the company was reported a revenue of 2,000 crores in 18. It reported the revenues of 2,050 crore in 19, and again 2,000 something crore in 2021. Okay, and profit margins were also like 50 crores in 18, 80 crores in 19, and some 114 crores in 20. So like the increase in profit margin was very significant. So I can understand why the share prices kept rising. But now at this moment, it has risen 8 times from what the market cap was in 2020. So market cap was at 400 crores in 2020 when during the time of COVID, and currently it is at 2,500 crores. There is no change in the revenue, like a 20% year on year increase in profit margin. That's it. But the stock price is currently trading at 8 times of what it was in like a 1 year back. So, and there are many examples of such. There are many such cases where there is not much of changes in the financials of the company, but after COVID, when they were trading at what 1,000 crore market cap, now they are trading at 8,000 crores market cap, and no changes in the financials. Absolutely no changes, like very minute changes. So my question was like, don't you guys think that some of the shares are at very extreme overvalued, like they are highly overvalued, and it's kind of a worry for new and people who have entered in the market after COVID, who have not seen the fall. So don't you guys think that the times ahead are not uh, as expected? This was like my question. If anyone can answer, how we can track such companies, how we can go about it. Thank you.
Sure. So I'll add a couple of points here. Uh, First, can you keep yourself muted when I'm talking? Because there's a lot of echo. Yeah. So one is it's the packaging film industry. So to understand that industry, you'll have to understand Cosmos products, and it's not particularly a company that I track. What I can say about companies where revenues might not have changed drastically, but the stock prices have gone up. One that it is the stock market is a discount machine. They're trying to uh, uh, they're trying to discount what they think the future of that particular company is going to be. Now, with a lot of turnarounds or a lot of companies which have benefited due to the leaner interest rate environment and the easier access to money, such companies would have their growth trajectory moving forward would have become a bit better. And as that happens, as things move on and the story starts to change, the valuation or the stock price starts to reflect what the market believes that consensus story to be. And in a lot of cases that might be right, that might be wrong. Gurmeet just spoke about how that's happening with the chemical sector, where a lot of chemical companies are getting specialty chemicals sort of valuations. A lot of cyclical elements are not being taken into consideration. So again, without commenting on the company in specific, what I would try and do is first and foremost understand if there's something fundamental which is not yet reflected in the numbers that has changed. Something like what happened in the case of Subex, where the company was changing their business model from just being a service related company to also building a product stack. Now that product stack is a while away, which is why the price ran up a little bit, then it came down again. But the fact is that when you look at companies like this, you have to try and understand, okay, fundamentally what has changed. Because when there's a rumor, when there's news, oftentimes the price runs up and then it corrects because the market sort of figures out that the trigger in itself is about 15 months away, or a year away. In fact, I also wrote about this in my position sizing thread, where I spoke about four different forms of position sizing, which would be trigger based, was one of those formats. Risk based was another one of those formats. Equal weighted was another format. So understanding where the company is from its triggers is very important. If those triggers are huge, of course, the prices will start to reflect that, even if there's no change in fundamentals. But in a lot of cases, the price will run up far ahead of fundamentals. And you can try and understand this with by understanding what is driving up the margins right now, what is driving up the revenue growth, and is that going to be sustainable or not. Parvez, Mohit, do you have anything to add on the packaging sector?
Uh, if I can add over here,
Yeah, bro, go ahead.
so we got to understand. I guess Cosmo Films is a competitor to Polyplex Films, and now you got to understand where these films are used. I'll first explain the sector. I am not totally into the sector, but I had read a little bit about it because it was related to EV, and I have been tracking electric vehicles. So these films are used into lithium-ion batteries. So though the revenues have not drastically increased in a short run, but they are expected to increase multifold in coming years. I'll give you an amazing example of what happens to such companies where you would have seen like 4 to 5x returns in last 1 year. And all these companies, if you go to see, the inflection point was November 2020. That is when Biden became the president. Earlier, Trump, he never used to believe in climate change, but Biden was totally committed to climate change. So all these EV companies, all these green companies, green energy companies, they all started shooting up since November 2020. That's when Biden came. That's a little bit background. Coming to the companies, I'll give you a very good example of Olectra. Olectra is an EV electric vehicle. They manufacture buses, right? At 1 year back, the stock was trading at 120 or something, and today it's trading at 900. So you can save more than 5x returns in less than a year. So what had happened at that point of time? Olectra had a capacity of around 1,000 to 1,500 buses per year, right? And they were doing sales of around 100 and 150 buses on a quarter-on-quarter basis. What happened is, last, like when the government started committing on their EV goals, or green energy goals, or becoming carbon neutral, that is when these companies came into the picture. Now, Olectra has expanded its bus building or manufacturing capacity from 1,500 buses per year to around 10,000 buses. So you can imagine the growth that it is going to have. Now, when a company is making that much capital commitments, it is also seeing future sales. So the prices today reflect the revenues and the net profits of the future, and that is why you see these 4x, 5x stock prices going 4x, 5x in no time, because they see that much sales coming in the future. That was from my side. If I could answer the question.
Was that helpful at all?
Yes, it was. It was very much like example of Electro completely answers my question. Like we'll have to look at the future. So these prices are reflecting the future revenues and profits.
Exactly. That is what prices always will reflect. They would not reflect what, because there is this simple concept in finance where whatever you have on the balance sheet is already uh, assume that it is like, even if you're taking a free cash flow to equity, that is already owned by the shareholder. So whatever the future values of stock is made up of current values and future values. Future will offer you growth. So the more the growth in the future, the more the stock prices move today. I hope I was able to explain some part of it.
Yeah, I think let's move on because we've got a bunch of people who are still requesting to join up. So expert and then Chintan and then Vibhor, can you unmute, ask what you have to say, if you have a question or something to share, because we'll keep moving people down as and when they're done with their question. What's your actual name? I get it, Cindy Chokro, but like.
My last two initial, I mean, VB, my name is Vinay Batija.
Vinay, okay, cool. Yeah, so Vinay, you can hang out here. We'll keep like replacing the other speakers as and when because we are at capacity. But you can
Sure,
hang
sure,
out
sure.
and sort of like
Sure, sure.
chime in wherever you want.
Sure, sure.
Cool. Expert Chintan Vibhor.
Yeah, I can go ahead with the question. The question is
Cool.
how can we identify the parameters for finding, multi-bagger stocks? If anyone can
Wow,
answer.
that's a that- so I mean when you want to think about what a multi-bagger is, right? A multi-bagger is essentially something that generates multiple times its investment value, and therefore it is essentially something that compounds over a long period of time, that has a good stock growth, good earnings growth, and to some extent, also PE multiple expansion would be great. It also helps a lot when you talk about things moving up. So there are a couple of triggers that I'll talk about, and then I'll also leave it to like Parvez and Vinay if they want to sort of chime in and add anything. So first and foremost is like the valuation. If you're able to pick up something that's reasonable in price, and you're getting a decent valuation, those are those are likely to run quite a bit longer. Uh, then you another trigger is that what is the sales and earnings growth over a long period of time. So here obviously with multi-baggers, smaller companies help. If you have a company that's at 10 lakh crores, I mean, it can still be a multi-bagger, and it probably will be, uh, because it's created such a dominant position for itself. But for myself, I found that companies in the small and mid cap space can become multi-baggers much easier than larger companies can, because uh, the base on which they're building on is lesser. It's not as big as uh, the bigger companies are. Another trigger I'd look for would be margin expansion. Something that's not at peak margins, and that just means like operating leverage is still to play out, or their product mix can change and they can go into higher value products, and that can to a certain extent increase the earnings going forward. Because at the end of the day, you have to remember that the stock can only go up if either the PE multiple is expanding or the earnings growth is expanding. The PE multiple can't expand beyond a certain limit. So over the long term, you have to look at what's going to drive earnings growth, and that's going to be margin expansion, that's going to be sales growth, and that's going to be product mix change. So these are some of the things that I think can be a factor. I'll also pass it on to like Vinay and Parvez.
Okay, thanks, Krishna, for that. I hope I got your yes, Krishna. So I'll speak how I find my own multi-baggers. I have two ways of finding multi-baggers. One is the policies. I am always aware and reading about the new policies that the government is coming up. I'll give you a very good example. Is say for Zen Technologies. Zen Technologies was trading at something around 30 to 40 uh, few or 12 to 13 months back, if I'm not wrong. And that stock is today trading at 230 or 240 something. So what had happened, government has liberalized these drone policy. and these guys make drone. And the future of delivery is definitely drones. If you could look at how the e-commerce space is shaping up. So I won't get into the financials of it at this point on because that would be really lengthy. But always look at the policies of what the government is doing, because the next growth of uh, that is where once you understand what government is trying to do or what sector the government is trying to liberalize, that is where the growth is going to come. So look at what the policies are. Second, look who is going to capture the market share when the policies are right. Say, so there aren't many drone making companies or listed drone companies in India. So this was one of the companies that used to do it, and it's as Krishna said that it also had a lower base. So multi-baggers are, they are built really fast when they are at a lower base. So this is one thing that I look at, the government policies, and the second thing that I look at is special situations. Now, what would I call a special situation is like when there is a merger or an acquisition going on, or when a company is going to demerge one of its businesses. So if you go to see Mirza International now, if I have to explain you that company, it has different verticals. Hey Krishna, I'm getting a call. It's a very important call. Can I just come back?
Yeah. Just mute and come back whenever you can.
Sure.
I would just like to continue. Like, I was more interested if someone is from a technical analysis background, can we find out with specific conditions in technical analysis multi-bagger stocks? If anyone is deeply rooted into technical analysis stuff, long-term chart analysis, monthly analysis. So, is there anyone in the space who is into deeply into technical analysis, and we can find out technically also? Of course, fundamentals should support, but if something we can do with the technical, and let's say we can have 1,000 stocks, we shortlist 20, 30 of them, and then we go for the fundamental thing and check out both of them. So that would be a very good mixture of techno fundamental analysis. So anyone interested in sharing some conditions technically when this conditions occur, then it should be a potential multi-bagger.
Parvez, do you have anything you want to say about this?
Yeah, Chintan, I've been doing technical analysis for the past 25 years, and I use a software called Advanced Get, and it's pretty phenomenal software. But if you're looking for a multi-bagger, I would say that you really need to look at maybe a weekly or a monthly chart and find out the stocks that are actually closing with high volume over the previous high at the very rock bottom. So the way the whole thing works is, just to let you make you understand, is there's a person by the name of Elliott wave who talks about the Elliott wave theory. There's a whole theory called Elliott wave theory, and the way it goes is that it goes on 5 waves up and 5 waves down. And the reason it goes, let's say five waves, is the first wave up is because of some sort of thing that is happening in the company that is maybe a game changer, and also the insiders know about it and they buy it, and that's the first move up. And then the second move comes down when they've bought whatever they need to. The demand comes down, and that comes the second wave down. And the third wave is one of the most powerful ones, where it gets into the public, and news starts flowing out, and the whole scenario comes into play, and there's huge volume going up on the third wave. And that's where it then settles down again, where there's profit booking, and then it comes back down. And the fifth wave is the final wave up, which is where there's more room left for profit making, and the results start clicking in, etc. Now, if you're looking for a multi-bagger, that is where one should start at the very beginning. And like you said, very well, is that you need to also correlate these kind of breakthroughs. And when you see a huge price volume action. Price volume action means a huge jump in price and a huge jump in volume, and that's where there is something very interesting happening in the company, and you would start researching that. So if you're looking, I mean, your question is predominantly about multi-baggers, and therefore I'm explaining this to you. If you're looking for a multi-bagger, then that's probably where you will find them at the very bottom with this kind of price volume action happening. But then that is up to you to then figure out the fundamentals about it, what kind of thing that really supports this particular stock or company that could potentially make it a multi-bagger. Is it a government policy? Is it something new that the company is doing? Is there a disruption that they are providing in a certain sector or a certain industry? Various things like that, right? And so they also might diversify from a product that they're already working. A lot of these companies tend to even disrupt themselves, and that's a phenomenal thing that happens in companies. Krishna was mentioning about me having won the prize on Multiply for a stock, and that is one of the things that I deciphered is where Satya Industries has a potential of being a multi-bagger because there are all these parameters that work for it, right? There are government policies that are supporting it. There's a disruption that is happening not only within the company where they're moving from paper to biodegradable products, and then also disruption in the market where they're going to be disrupting the single-use plastic containers, etc., etc. So those are the kind of parameters that you would want to look at to support your technical with the fundamentals to identify these kind of stocks. Not everyone is going to be a multi-bagger, maybe not. But if you take a kind of a entry into it with a small allocation and then track it and then continue to add to that, you get a better average for a certain stock, and then ride it until it comes to fruition. That's basically the way to do it. I hope I've answered your question.
Yes, yes, absolutely. It was wonderful to hear your thoughts on this.
Yeah, good. Thanks.
Cool. Chintan, I'll be moving you back to the audience. If you have another question, you can always raise your hand and come back up.
Sure, sure, sure.
Cool. Milind, you can go. No, it's Vibhor and then Milind.
Okay. Sure. So I had a question regarding a recent thing which Tariq shared. This was regarding the new age startup selling used cars. So he had shared a video there, and I watched that video, and that said that the number of used cars that are being bought are roughly 3 times that the number of new cars are used. And also, these traditional automobile companies like Maruti and other Tata, they are already selling their own used vehicles in separate franchises. So I wanted to ask, what's the why would someone prefer to go to a new age startup than go to these traditional companies who are selling their own used vehicles? For example, I myself had gone to Maruti itself instead of going to the new age startup. So they might look good as a customer perspective, but from an investor perspective, they are simply burning a cash. I just wanted to know if somewhere someone is tracking these companies.
So I don't track the companies. Vibhor, can you mute? Yeah. So I don't track those companies, but I'll give you some anecdotal evidence from what I looked at during the car trade IPO, right? So if you look at the traditional setup, right? Now, yes, the companies themselves, like Maruti and Tata, are doing the whole used car thing. But to a large extent, people in a lot of towns, and even in the cities, don't usually go or don't think to go to their own car manufacturer to go and be like, do you have an old car of this version available with you? That's one. And second is, even if they do, there is it's not, I mean, it's the search functionality or the discovery functionality is not great. So that's one of the aspects. And also, if you were to go and buy a used car, and actually Shubham, who goes by the handle of the logical investor, uh, he also went and just recently bought a car. And one of the interesting things that he pointed out, which I've also got as feedback from a bunch of friends of mine, is that when you were picking up a used car from anyone, you would have to get your own mechanic or someone else's mechanic in order to analyze that car and see, what parts work, what parts don't work, what exactly are you getting. And that became a huge hassle for people to come in and buy that, because even if tomorrow you get the mechanic to audit the car, that mechanic doesn't have any real responsibility in the equation, right? If tomorrow something's wrong with the car, you can't go catch hold of the mechanic and you and go like, this is what you saw, this is what you did. And this to me is are the two main factors which focus or bring special light on these used car web portals. One is the search. So if you want a specific vehicle or a specific kind of vehicle that might for you be difficult to find normally, um, you can find that vehicle through the website with ease. And second is that the you'll always have someone you can reach back to and be like, this is not what I got, or this is not uh, what you signed up for. They will to a large extent be able to go through the hardware and be able to point out that this item in specific is in working condition, everything looks great, because economies of scale in this aspect should be able to add a lot of value. um, Utkarsh, Vinay, do you have anything to add?
No, no, I don't track this sector, so really not well versed with it.
Mukesh, do you have anything that you want to ask, share, talk about?
Yeah, I want to ask one, basically 2 to 3 questions. First is that when suppose you have found out a company which works out to be good for you, considering it a small cap or maybe a micro cap, but or even if it is a mid cap also, then what are the ways to uh, what are the ways to what are the ways to guess that now the earnings have peaked out of the company? Now from there onwards, the growth will not be as per the as per the scenario which you have encountered in last 1 or 2 years, or maybe two years or 3 years. If you have found out some good company which has given you good returns, and now you want to exit out, how to analyze that now earnings are on a situation where they are getting peaked out with the time? So the growth will be there, but not with the scenario which you have seen in last 1 year or 2 year. This is more, this is a kind of while I was reading and all things, then I encountered this thing that normally bigger investors or those who are good, they have a good experience in the market, they normally exit these small companies or mid cap companies, and that is where they exit out. And retailers think that now maybe they are wrong, that investors are wrong or whatsoever. So first question is this: are there any ways to guess or to at least estimate where the company's earnings are getting picked up from there? Or from this time the growth will not be as per what it had been in past? I mean, a person could be wrong also. And second thing is that there is one company which I have was studying, which I had studied in last 4 or 5 days. That is Calcom Vision Limited. It is basically into LED manufacturing and all. They are, as per the annual report which I have read, it seems to be very good company. Though it is a very ultra micro cap, but I heard that I think Kenneth Arnett has interest into this company. So thereafter, I started reading about it, and to me, the company seemed good. If somebody has tracked it or at least looked into it, he could guide this me into this. Only these two questions.
Cool. So the first question I'll take. The second one I don't have a lot of information about, so I'll leave it to the rest of the people on the panel if anybody can chime in. So as far as the first question, if or peak margins will happen generally in companies that have some cyclical element. So if for example, like you take any company's end product, just try and ask yourself this question: is this a product which its price goes down with time, or can go down with time, or is it something that has a linear, up move kind of growth? Now, to give you I mean, this is a very easy example, but let's take for instance, two things, right? One Indian and one international example. One would be like Coke. I mean, you don't see the price of Coke go down ever. Any Under any circumstances, the price of Coke doesn't go down. And At the same time, when you look at something like like a slipper, like a relaxo chappal, which is selling at say 119 or 120 rupees, now the price of that doesn't go down. So therefore, the fluctuation in margins or peak margins cannot or should not happen. Then there are also things whose pricing is determined by the demand and supply available in the market. So that could be cement, that could be steel, it could also be like items where the value add is very low. And that could be anything that's not branded. And the pricing of that product is a function of demand and supply. Now, products like this, right, in moments of squeezed demand, um, uh, I mean, elevated demand and squeezed supply tend to create peak margins. So, if there is a particular chemical, for example, that's needed in a COVID drug, or there is a particular API required in a COVID drug, these are just examples. And there is one company or two companies currently which already have manufacturing capacity. The price for those products will skyrocket, and then as capacity comes up, the price goes down normally. Another great example or way to look at it would be the shipping industry, right? If you look at the profits of shipping industry over the last year, they've been astronomical. I don't think in history they've ever had profits like that, because it takes 18 months for you to put together a new ship. So that's how long it takes for capacity to come on. But I mean, if investors were to go on and think that now shipping is the next wonderful industry to get into, when new supply of ships, which was taking 18 months to come on, actually does come on, you'll have a situation of oversupply. And in such a situation, the pricing will go down significantly. So all you have to try and figure out is, is the end product of the company that I'm working with or working on, is that does that have a cyclical element to it, or is it a structural sort of increase with time? Another key thing to look out for is if the company has the ability to pass on any increases in cost to the consumer, whoever that may be, whether it is the individuals or a business.
Yeah, okay, I got it. And there is one more thing also that I think comes up in that concept. Maybe maybe I'm not aware of, or is it not much in trend here? But normally keep seeing it on Twitter and all other things. There is a concept called total addressable market. That is TAM. So, is there any way how a person like how we can how we can that calculate that thing, or how can we at least address that thing. Normally we look into the what this concept is not very much in public domain, as if what could be the total addressable market. We normally look what market share the company holds and what it can capture against what is total addressable market. So how to differentiate these two things if somebody is analyzing few of the companies like platform companies, or maybe some which are B2C companies. So this how to calculate, or how, are there any ways to estimate this thing of total addressable market against this, what market share company has or what market share it can capture? Like these two things seem synonymous, but they actually while like when you are analyze when you want to invest in some invest in a company, these two things to me look kind of a different. So can you put some insight into it?
Sure, sure. I just also want to quickly mention to the group that this is the last question we'll be taking. After this, we'll be ending the space. In order to keep up with spaces that we'll be conducting in the future, I will be sharing a Telegram link to a group that we have. You can all go and join that Telegram group. Also keep a lookout on my Twitter handle. I'll be announcing. I try and announce more spaces at least 3 days in advance, but usually they'll be announced a week in advance. So you'll know when the space will be happening next. Um, yeah, and to answer Mukesh your question, um, as far as TAM goes, right? TAM as a concept is quite easy to figure out, because when you look at any particular item, say it could be footwear, it could be soft drinks, whatever the item may be. One thing you can do is you can look at what is the penetration level in India versus the penetration level in developed markets. So that will give you a sense of, okay, what is uh, the total addressable market, or the market that you could pick up on soon from now. Another factor I'd like to talk about is to look at what the per capita income of India is, and place the product in where do you think in that structure it fits. Because we could have this humongous TAM in a country like India, because you have 1.3 crore people, 1.3 billion people in India, 138 crores. So the TAM for everything is going to be great, right? But the point is that uh, you can't say that the TAM for Louis Vuitton bags in India is 138 crores. It makes no sense. You have to correlate that with what the earning capacity of people will be. So every state has its own per capita income, and you can look at the cost of a product and compare that to what the per capita income is, to get a sense of how long would it take for that product to become mass. Like air conditioners, for example, have a huge TAM in India, and that TAM will keep increasing because they are priced in a sweet spot where the move from 2,000 to 3,000 to the $4,000 per capita would benefit those businesses, but certain businesses might not benefit in the same way. And it you need to figure out where in the whole TAM story do those things lie. Milind, did you have something you wanted to say?
Yeah, Krishna. Hi, Krishna. So I have a question. So I have a question like, how is the chemical sector looking to you in next 6 months? Since lot of good chemical stocks like Deepak Nitrate or Jubilant and Greva, Balaji Mines are available on Deep now. You can buy on Deeps that stocks. So how is the chemical sector looking to you?
So the chemical sector in itself is quite, it's quite big, it's quite complex. In order to be able to figure out, it's because each product or each chemical is used in multiple end products, and that's why my exposure to the chemical sector is, it's actually one of the smallest out of all the sectors that I have, because I sort of stick to the circle of competence. Um, uh, you know. Um, theory and mindset. But I mean, if you want to learn more about the chemical sector or you want to get more answers about it, I think Ishmohit or SOIC would be the people to follow. That's Ishmohit. One is his handle, and the School of Intrinsic Compounding is the company name as well. So he does a lot of chemical in investing in general. For me, I mean, my chemical exposure is too low, and my understanding of that industry is too little for me to have any sort of outlook.
Okay, okay, understood. Thanks, Krishna.
Yeah. With that, I'll also thank the audience. Thanks everyone for tuning in. I'll share the Telegram link to the group right after this talk. I'll keep it up for about an hour because we then otherwise tend to get a lot of trolls, which I then have to like individually remove. So I just want that people who've hung out in the space, they get access to talk to other people as well from the investing community. Also want to say thanks to Vinay for sharing his inputs. And two of our regulars are also here. One is recording space, which is at the rate one recording space. um, he comes in and records a lot of the fun spaces that we do. And if you ever want to catch up on a Twitter space recording, he's the guy that you want to go and follow. Another one is Mohit. Mohit goes by the handle Agarwal Mohit 12. He and me are doing a bunch of spaces around the green transition. We did one around electric vehicles and mobility. We will be doing another one on hydrogen and then one on biofuels as well. So keep a lookout on both my Twitter handle and Mohit's Twitter handle for that. Yeah, and with that, thank you guys for showing up, and I'll see you in the next one.